Hello all, my name is David Holt. I'm an equity analyst and portfolio manager here at CFRA. I really appreciate you clicking on this link, and I'm super excited to really tell the backstory around what CFRA model portfolios are and how they might make a good fit for your specific investment strategy. So importantly, we'll provide a glimpse into what we really think separates our process to make good stock selections and how our portfolios have done over different time periods. So diving right in, the key point I try to drive home here is these model portfolios are designed for you as a client. We have different flavors of portfolios to really provide you with investment ideas for any market situation. We take our time-tested methodology that's really built around both qualitative and quantitative ranking systems to provide you with unbiased thought leadership that has a proven track record of outperformance attached to each of these strategies. So lastly, and what I think is a key distinctive factor versus other peers that I mentioned is our analyst expertise. So we have a worldwide scale, 75 different analysts that cover 11 different sectors. And importantly, we focus on both fundamental and forensic analysis for equities. So together here, we have 15 stock and ETF model portfolios available, shown on the right-hand side of this slide, with 5 that are actively managed by the Portfolio Management Committee. The committee consists of a 12-member team with a combined 200 years of investment experience. So each of these actively managed portfolios consist of a lead PM and are supported by co-PM. So we really feel that this structure prevents us from being married to individual stocks, so we can work together as a team and check each other's blind spots to manage risk more efficiently for you as a client. So importantly, our team actually consults with a guy you may have heard of before, Sam Stovall, our chief investment strategist, on a regular basis, so we can really develop and craft our own strategies to provide the best ideas possible for you as a client. So as I mentioned before, we have different portfolios for most investment styles, everything from top 10, which really encompass our 10 best ideas, high quality capital appreciation, which I actually manage and we'll get into a little later, and small and mid cap growth, which focuses on companies with a market cap of 7 billion or less. And total return also hones in on companies with attractive capital gain and dividend yield potential. So we have focus stock of the week as well, where we release our strong buy rated stocks with a write-up on a weekly basis. And so again, it's a very diverse set of model portfolios for everyone. So next, performance, which is front and center for most investment strategies. CFRA remains intensely focused on performance, and we really acknowledge that real money's at stake here. So here at CFRA, we're accountable for both the calls that we get right and the ones that we do get wrong. So that said, I would be remiss if I didn't mention the fact that this slide really details that we get more calls right than wrong on a long-term basis. And all CFRA portfolios here have exceeded double-digit growth on an annualized basis over a 10-year time span. So I really think that this differentiated performance really falls back on the talented individuals that comprise the portfolio committee and analysts across the organization. So that rabid curiosity and that knack for picking up on some of those items that many may miss make for good stock pickers, in my opinion. So with that, I thought it might be helpful to dig into an example with high quality capital appreciation, which I manage. The fund has been around since 2003. It's one of 5 of our actively managed portfolios. And on the bottom left, with portfolio characteristics, you can see it's concentrated. So we have 15 names in total in the portfolio, and it's large cap focused with an average market cap of around 99 billion. So the dividend yield is in line with the S&P currently at 2.3%. And if you look at the bottom right of the table, I've listed some of those risk characteristics. So I would probably highlight the R squared and the maximum drawdown, which could be attractive for investors that might like that margin of safety, and also really helps underscore the defensible nature of the portfolio. So it's held up pretty well given the recent spurts of volatility, and with that lower correlation to the equal weighted S&P 500, really explains that, and the equal weighted S&P 500 is the bench. So next we have sector weights, and I've really tried to highlight where we are underweight and overweight positions currently, and why active strategies can have a role in helping you as an investor. So we intentionally entered 2019 market neutral, but as market averages continue to march higher, we got more and more defensive. So we pivoted towards those healthcare names and the utility names of the world. And it really helped capture some outperformance with the big drawdown that we did see in February and March of this year. And I think this is a perfect segue into how we really source the stocks that enter and exit the portfolio. So we have requirements, which you can see at the top left-hand side of this funnel with the stars and quality rankings. If either drop below the necessary thresholds with a downgrade to hold or below, or an A- or below, we need to find a replacement for that. So as you move down that funnel, we can list a few other characteristics that we're really looking for when we put names in the portfolio. So for example, each name is really put through a grueling process of both fundamental and forensic factors, which we believe is a key element of what can distinguish us from peers. So lastly, with the final 2 to 3 stocks that actually make that cut, we vote on those to determine what's added to the portfolio. And on the right-hand side, we just have some other key inputs that we consider for this individual portfolio. But again, every manager and portfolio that we offer have their own characteristics. So with that said, I would say the big caveat is all have one common theme in mind, which is outperforming their bench. So, and here's the output. So the key takeaway here is the portfolio has performed well in up, down, and sideways markets since inception. So as I mentioned, we went beta neutral to close out 2019, which meant taking on a little more risk, and that's the real reason why we actually lagged our bench in 4Q19, which you can see in the table here. But we were able to make that ground up and then some to 1Q20 because of some of the moves that we previously made. So lastly, as you can see from this chart, we've been able to outperform from most key milestones dating back to inception. So year to date, we are outperforming our bench and doing whatever we can to ensure that it stays that way. And this is where I think it could get super interesting for any kind of stat buffs that are out there. When you look at market capture rates, especially in conjunction with excess return stats, the performance has actually been pretty exceptional. First, when you look at the up market capture rates, it's steadily improved relative to our bench in the past couple of years. And same goes for down market capture ratios. When you look at past stints of volatility, where you've been able to materially outperform, especially in the last year, where a measure of 70 means you've only captured 70% of the market downside. And then secondly, with batting averages, as the name entails, gauges if you can outperform your bench more days than not, and indeed it does have a distinct correlation to the great American pastime sport, baseball. Now, a lot of people dismiss batting averages, but because it doesn't really account for sheer excess returns that a portfolio can generate, which I agree with, it can be 2 basis points or 200 basis points on any given day. But given I've already shown you some of the outperformance metrics and excess returns in prior slides, I think it's really telling that we can bat over a 500 on a regular basis. So at nearly 67% currently, I would point out that the high quality capital appreciation batting average currently ranks in the 5th percentile across stocks and bonds, according to Zephyr Analytics. So with that, I hope this walkthrough was helpful, and you can learn more about CFRA research and our methodology by visiting MarketScope Advisor or contacting us by phone or email, which is listed on this screen. Thanks for listening and have a great day.